Welcome to the Equity Market Minute by Bloomberg Intelligence. I'm Gina Martin-Adams. Earnings growth for the S&P 500 appears to be in the process of peaking. But is this particularly meaningful for the outlook for stocks? Let's take a look at a couple of charts. What we find is that an earnings growth deceleration is fairly common and generally means price growth should decelerate as well. But what is really dangerous for the outlook for stocks is when earnings growth actually contracts. One leading indicator of a contraction in earnings growth is to look at cyclical sector earnings growth relative to defensive sector earnings growth. What we see in this chart is that earnings contractions of the past have been led by this indicator. So we want to watch really carefully for cyclical sector earnings growth to deteriorate fairly quickly going forward. This is not in the forecast right now, so generally the earnings stream remains a support to stocks. My second chart shows something that we really should keep a close eye on, and that's capital spending. Most investors seem to believe that a recovery in capital spending is a very good thing. Indeed, it does tend to occur with a recovery in sales growth. However, capital spending is not a leading indicator. It is in fact a lagging indicator, and at the tail end of every cycle of the last 20 years, companies have sort of thrown spending discipline to the wind. If capital spending continues to recover at an incredibly robust pace, it could start to eat away at margins uniquely in this cycle as well as a result of tax reform. We want to watch pretty carefully to make sure that sales growth continues to accelerate at a relatively robust clip, supporting the capital spending recovery. Thanks so much for joining me for the Equity Market Minute by Bloomberg Intelligence.